Hello, everyone, and welcome to the HHM Accounting Standards Update, Lunch and Learn that we're putting on for you today. My name is Randy Dummer. I am an audit partner in the Chattanooga office of HHM. I've been with the firm for a little over 9 years and was previously with another firm up in Wisconsin for 24 years. I'm primarily in the quality control area and also am the firm-wide leader of our employee benefit plan audit practice, as well as the peer review practice that we have here as a firm. My co-presenter today is going to be Erica Smith. She's a senior audit manager in the Memphis office, and I'll let her introduce herself a little bit here as well.
Hello, everybody. As Randy mentioned, I am a senior audit manager here in the HHM Memphis office, and I do apologize if you hear some construction noise. There was zero until just about 5 minutes ago when this presentation started. But I'm excited to be here for the opportunity to speak with Randy on the FASB accounting standards update. Randy has a unique ability to even make FASB accounting standards seem fun. So our hour today should fly right by.
Well, thanks for putting that extra pressure on me there, Erica. Well, and I have been doing presentations for quite a while, so I generally feel relatively comfortable. So hopefully we can keep this light enough that despite the heaviness of the topic, that it will at least keep your interest as we go. We do have 3 different areas that we've kind of broken this presentation down into, as you can see on the slide. First, we're going to talk about some of the significant accounting standards updates that were issued prior to 2019. Those are ones that either are becoming effective in 2019 or 2020, or whose effective dates just keep changing. And we'll talk about that later as we go through the presentation here. Or ones that are just extremely significant that we really felt should be addressed in this presentation. Because the other 2 sections that we've got are the accounting standards updates that are issued in 2019 and 2020. And I'm going to give you a little spoiler alert here. There is not a lot of meat and substance to the 2019 and 2020 accounting standards updates. So there are, I believe, 23 that have been issued in the last 2 years. A lot on very narrow and very technical areas, and some which aren't going to necessarily apply to the typical client that we see. And since our primary invite here is our client base, that's how we're going to focus the presentation. And so when there are things that just aren't that applicable to who we think is in the audience, we're going to just kind of gloss over those a little bit. So that's essentially what we're going to cover here today. And I'll just give it one more little overview here. Is I actually read some of these accounting standards, which is, I think, kind of sad. But essentially, for an extended period of time, probably from 2008, 2009, through about 2015 or 16, when they put the summary in the accounting standards update that they issue, they say why they issue the standards. And sometimes I read through them and still don't believe that there was really a reason, but yet they put that in there. And so for the most part, from that time period, again, late 2000s to mid 2010s, the primary reason for issuing accounting standards updates seemed to be to converge with international financial reporting standards. There was a huge project and a huge push to try to get IFRS and US GAAP as close as possible. Now, they didn't always achieve that goal, but that was essentially what they were trying to do. I think under the premise that eventually the goal was to have one set of global accounting standards. I think they've maybe drifted away from that a little bit more, but certainly there's a completely different focus. That stuff from the mid 2010s, so the last 5 years or so, when you read the why did we issue this standard, almost exclusively it's going to say for simplification. Now, how they can issue multiple standards every year and say that they're making our lives simpler is a little bit beyond me, but that is indeed what they say that they're doing. So with that, we're going to get into some of the content here, starting with those pre-2019 accounting standards updates. And since I basically got to put together this presentation and determine how it went, Erica's going to cover all the tough stuff. So the first one here, revenue from contracts with customers, takes away Accounting Standards Codification Section 605, replaces it with 606, called Revenue from Contracts with Customers. and had an effective date for non-public companies for 2019 calendar years. But then, as we will tell you towards the end of the broadcast here as well, on June 3rd of 2020, and that's an important date, June 3rd of 2020, the FASB issued ASU 2020-05, which deferred it if you had not currently adopted it for an additional year. So then it would apply first to the 2020 calendar years. So as a peer reviewer, I look at financial statements and I see a 2019 calendar year financial statements and I say, well, gee, they should have adopted the new revenue recognition rules, unless those statements were issued after June 3rd of 2020, in which case it's now optional and they can push it back another year. So a little bit of curveball nuance that they threw to us in adopting these, which is odd given that if you're going to adopt the revenue recognition rules for 2019 calendar year, you probably should have been doing it on January 1st of 2019. So a year and a half later, they said, hey, we'll give you an extra year to take care of this. So with that, Erica, why don't you go into more details of what this new standard entails?
Thanks, Randy. And I am also very thankful to Mr. Martin because he got drilling for a few minutes. So that's awesome. I hate to slow down progress, but I want to make sure you guys can hear me because revenue from contracts with customers is fun and exciting stuff. And I don't want anybody to miss any of that. So when I see a new FASB update, mentally, I usually assign them levels in my head, such as this isn't going to be too bad, or okay, this is going to take some thought, and I hope I never, and then the final level, I hope I never see this. So on the revenue recognition standard, I think this falls into my category, okay, this is going to take some thought. It is an important standard, and there are presentations that spend hours going over it. Lucky for you guys, this is not one of them. Today, I am just going to do a brief overview, but did want to point out that there is a wealth of information on revenue recognition that you can access through the BDO Alliance portal if you want to delve into the topic further or need some real-world implementation guidance. So revenue recognition. This is one of those standards that is not a one-size-fits-all. You must get a good understanding of your client and their revenue sources because some clients, the standard will have a significant impact and others, there will be little to no impact. For instance, here in Memphis, we do a lot of nonprofits. And as we were implementing the standard in some of those this year, they really didn't have much more of an impact than just disclosure issues. But as you think about like construction contractors and automobile dealerships and those type of industries, they're going to have, this revenue recognition standard is going to have a lot more impact to them and require a lot more work on that side. So what I kind of wanted to talk about is the meat of this standard lies in the fact that revenue from contracts with customers is recognized based on the application of a principle-based 5-step model. And that's kind of what we're going to go over in a little bit more detail today. So best place to start is the beginning. So let's look at the first thing that we need to do, and that's to identify the contracts with customers. Features of a contract under topic 606 is that contracts and approval of contracts can be written, oral, or implied by the entity's customary business practices. Topic 606 requires contracts to have all of the following attributes. So we want the contract has to be approved, the rights and payments regarding goods and services to be transferred can be identified in the contract has commercial substance, and it is probable substantially all of the consideration that the vendor is entitled to will be collected. And in this aspect, you only consider the customer's ability and intention to pay. If each party to the contract has a unilateral enforceable right to terminate a wholly unperformed contract without compensating the other party or parties, no contract exists under topic 606. So just keep that in mind. Now, combining multiple, another issue to think about is combining multiple contracts. Contracts are combined if they are entered into at or near the same time with the same customer if any of the following criteria are met. The contracts are negotiated as a package with a single commercial objective. The consideration for each contract is interdependent on the other, or the overall goods or services of the contracts represent a single performance obligation. And then another thing that you need to consider there is contract modifications. So a contract modification would be a change in enforceable rights and obligations, which could be a change of the scope of the project, the price of a project, anything in that contract. And it's only accounted for as a contract modification if it has been approved and creates new or changes existing enforceable rights and obligations. Contract modifications are accounted for as a separate contract if and only if the contract scope changes due to the addition of distinct goods and services, and the change in the contract price reflects the standalone selling price of the distinct good or service. Contract modifications that are not counted for as separate contracts are accounted for as either replacement of the original contract with a new contract or a continuation of the original contract. So replacement of the original contract with a new contract if the remaining goods and services under the original contract are distinct from those already transferred to the customer. And continuation of the original contract if the remaining goods and services under the original contract are distinct from those already transferred to the customer and the performance obligation is partially satisfied at a modification date. Or you can have a mixture of either one of those, a replacement or a continuation. Those are not considered contract modifications. So now that we've identified our contract, we want to move on and identify performance obligations in the contract. So that begs us to question, what is a performance obligation? Well, a performance obligation is the contractual promise by an entity to transfer to a customer distinct goods or services, either individually, in a bundle, or as a series over time. So what does it mean, like distinct goods or services? Well, there's two criteria to that, and or two portions, I guess, to the definition. The customer can benefit from the goods or services, and that benefit can either be through the use, consumption, or sale, or held in any way to generate economic benefit. And benefits from the goods or services can either be on its own or together with other readily available resources. For example, those that can be acquired by the customer from the entity or other parties. Or number two, the promise to transfer a good or service is separable from other promises in the contract. This assessment requires a judgment and consideration of all relevant facts and circumstances. A good or service may not be separable from other promised goods or services in the contract if there are significant integration services with other promised goods or services. It modifies, customizes, or other promised goods or services, or it is highly dependent or interrelated with other promised goods or services. Activities of the entity that do not result in a transfer of goods or service to the customer, such as like administrative setup activities, are not performance obligations in the contract with the customer and do not give rise to revenue. So now that we've determined we've identified what performance obligations are in the contract, then we move on to determine the transaction price. So what do we mean exactly by transaction price? Well, the transaction price is the amount of consideration an entity expects to be entitled to in exchange for transferring the promised goods or services. An accounting policy election is available to exclude amounts collected from customers for all sales taxes from the transaction price. Otherwise, an entity must determine whether such amounts should be included or not if you don't make that election. The transaction price may be affected by the nature, the timing, and the amount of the consideration. and includes consideration of significant financing components, variable components, amounts payable to the customer, such as refunds or rebates, and non-cash amounts. So let's talk a little bit about accounting for significant finance components. This is required if the timing of a payment provides either the customer or the entity with a significant benefit of financing the transfer of goods or services. The transaction price is adjusted to reflect the cash selling price at the point in time control of the goods or services transferred. A significant financing component can either be explicit or implicit. And factors to consider there are difference between the consideration and selling, cash selling price, combined effect of interest rates, and the length of time between transfer of control of the goods and services and payment. A significant financing component does not exist when the timing of the transfer of control of the goods or services is at the customer's discretion, or the consideration is variable with the amount or timing based on factors outside the control of either party to the contract. And the difference between the consideration and cash selling price arises for other non-financing reasons, like performance protection. The discount rate to be used must reflect credit characteristics of the party receiving the financing and any collateral security provided. A practical expedient between the period between the transfer and payment is 12 months or less. Do not account for any significant financing component. And so, and that leads into accounting for variable consideration. And that's things, discounts, rebates, refunds, credits, incentives, performance bonuses, contingent payments, penalties. Variable consideration must be estimated using either the expected value method, which is based on probability weighted amounts within a range, or single most likely amount. And that's the amount within a range that is most likely. For example, where there are a few amounts to be considered is where you would use that. Variable consideration is only recognized if it is probable that a subsequent change in the estimate would not result in a significant revenue reversal. So basically, it wouldn't significant reduction in cumulative revenue recognized. And so then accounting for consideration payable to the customer includes cash paid or expected to be paid to the customer, as well as credits or other items such as coupons and vouchers. Those are accounted for as reductions in the transaction price unless payment is in exchange for a distinct good or service received from the customer, in which case no adjustment is made, except where the consideration paid exceeds the fair value of the goods or services received, or the fair value of the goods or services cannot be readily determined. And then you also have accounting, when considering transaction price, you have accounting for non-cash consideration, and that includes receipt of goods of services or equity interest instruments from a customer. And those are accounted for at fair value contract inception. If not readily determined, is measured indirectly by reference to standalone selling price of the goods or services. So now that we've determined the transaction price, we're going to talk a little bit about allocating the transaction price to each performance obligation. The transaction price is allocated to each performance obligation based on the standalone selling price of each performance obligation. If the standalone selling price is not observable, it is estimated maximizing the use of observable inputs. Approaches to estimate may include adjusted market assessment approach, expected cost plus margin approach, or residual approach. And then we also probably need to talk a little bit about allocating variable consideration. Variable consideration is allocated entirely into a performance obligation if both the terms of the variable consideration relate specifically to satisfying the performance obligation, or transferring the distinct good or service within the performance obligation, and the allocation of the variable consideration is consistent with the principle that a transaction price is allocated based on what the entity expects to receive for satisfying the performance obligation, or transferring the distinct goods or services within the performance obligation. Allocating a discount exists when the sum of the standalone selling prices of all the performance obligations exceeds the consideration payable. Discounts are allocated on a proportional basis unless there's observable evidence that the discount rate relates to one or more specific performance obligation. So now that we covered allocating our transaction price, finally, let's talk about recognizing revenue as each performance obligation is satisfied. The transaction price allocated to each performance obligation is recognized as or when the performance obligation is satisfied either over time or at a point in time. Satisfaction, that's a big word, occurs when control of the promised goods or services transferred to the customer. Ability to direct the use of the asset, ability to obtain substantially all the remaining benefits from the asset is when satisfaction occurs. Factors to consider when assessing transfer of control: the entity has present right to payment for the asset, the entity has physically transferred the asset, they have legal title to the asset, risk and rewards of ownership, and acceptance of the asset by the customer. Recognizing revenue over time, the customer simultaneously receives and consumes all of the benefits. The entity's work creates or enhances asset controlled by the customer, or the entity's performance does not create an asset with an alternative use to the entity, and the entity has an enforceable right to payment for performance completed today. And then recognizing revenue at a point in time, revenue is recognized at a point in time if the criteria for recognizing revenue over time are not met, and revenue is recognized at the point in time which the entity transfers control of the asset to the customer. And with that, I'll turn it back over to Randy, and we'll move forward with this.
All right, thanks a lot, Erica. Now, one thing to bring up here as well, I had a discussion, I think it was last week, that we were talking about whether or not you put the revenue recognition disclosures in the footnotes or in your audit documentation as a public accountant. And the one person said, well, we don't have any contracts with customers because they were a fast food restaurant. Well, the contracts don't have to be written. So if I go, if you go to your favorite fast food restaurant, mine happens to be Culver's, although there are none here in Chattanooga, and I go through the drive-through, I basically tell them the food I want. Their performance obligation is to make that food and give it to me, and they do so while I hand them my credit card and pay for it. So happens at a single point in time. It's still recognizing revenue. It's still how you do it, but you don't have to have a written contract to have a contract with customers. Just clarification there. So moving on to some other items that maybe won't take us as long to go through here. ASU 2015-17 relates to balance sheet classification of deferred taxes, and this was one of those that was designed to align with international financial reporting standards. Because under previous GAAP, you would take current assets and current liabilities that had basis differences that created deferred taxes, and then net those within each jurisdiction and consider that to be a current deferred tax asset or liability. You take the long-term assets and liabilities and net those in each jurisdiction and come up with a net long-term deferred tax asset or liability. Well, under IFRS and now under US GAAP, all of those deferred taxes are considered to be long-term classification on the face of the balance sheet. So just simplifies things. You still net within each jurisdiction. So it is possible that you would have maybe a state net operating loss carryover that creates a deferred tax asset at the state level, and no net operating loss carryover at the federal side. So you have a deferred tax liability for the federal jurisdiction. So you could have both an asset and a liability. But otherwise, typically, if both jurisdictions go the same direction, or all jurisdictions, they would be netted as one line item on the face of the statements. ASU 2016-1 deals with some of the fair value measurement stuff that first came into play around 2008, 2009, and it's continued to get more and more complex. One of the areas of complexity that this is a simplification thing that they tried to help us out with is that investments are considered to be basically three different types: trading, available for sale, or held to maturity. And trading investments, which would be ones that are sold frequently, available for sale are not sold frequently, but would be available to be sold at any time in order to convert those into cash. And held to maturity would be things more like bonds that you would anticipate holding until they matured. They each had slightly different accounting treatment. And the thing that caused, I think, the most angst for me was that any change in the fair value of available for sale securities, which was what the bulk of the clients that I deal with have, if they have securities in a portfolio, was supposed to run through other comprehensive income and accumulated other comprehensive income on the face of the income statement and balance sheet, respectively. And that created a little bit of confusion and complexity there. So there was a fair value option that could be elected where you'd say, okay, basically we'll account for those, adjust on the balance sheet those securities to their fair value. But if we took the fair value option, we could run the change through net income instead of having to separately present comprehensive income. Well, ASU 2016-1, effective for 2019 calendar years and beyond, basically says that available for sale securities, the change in the fair value for those now does not run through comprehensive income. It runs through net income, just like a trading security would. So minor change there. So the next change is not as minor, and they keep deferring this now to start with 2022 calendar years regarding the new lease rules. And if they can kick it down the road for about another 10 years, I'll get to retire before the new rules come into effect. But Erica is going to talk to us again. I didn't want to talk about this one, so I pawned it off on her, and she'll tell you more about leases.
Thanks, Randy. I have questions in my mind if this one will ever actually go into effect. I don't know. I got used to the old rules, so I'm fine with it never going into effect, but I think we should cover it just in case. But this standard requires companies to report for the first time the full magnitude of their long-term lease obligations on the balance sheet, rather than being disclosed in the financial statement footnotes. Operating leases will move to the face of the balance sheet under Accounting Standards Update. And so in our overview today, I'm going to focus, since we just have limited time and I don't want to bore you guys to death, but I'm just going to focus on the leasee side because that's what we're going to see in our practice most. I mean, there are rules to the lessor side too, but they did not have as big of an impact as the leasee side will have. So anyways, leasees or lessees, however you say that. I'm from Arkansas, so I just say leasees, but anyways, currently account for operating lease payments on their income statements, but they do not account for future obligations on their balance sheets when you're talking about operating leases. Based on these new regulations, the updated guidance requires that the right to use assets be added to the balance sheet assets section and lease obligations and included in the liability section. And the lease implied rate or the incremental borrowing rate, whichever one is chosen, of the leasing must be discounted to its present value. The FASB's recent deferral will allow private companies and private nonprofits that have not already adopted the updated lease rules to wait to apply them to the fiscal years beginning after December 15, 2021. It is important to note that although the new standard retains the existing model of having two types of leases, operating and finance, the lessee's burden for recognition and measurement is increased. Under the old guidance, operating leases were not recorded on the balance sheet, as I mentioned before. Therefore, many entities did not evaluate leases embedded in service agreements or other short-term leases that were known to be operating leases. And a good example of this is that an entity might prepay for postage in an 18-month arrangement and receive use of a postage meter at each of its locations for free. The entity might have previously excluded the usage of the free postage meter from its lease analysis because there was limited or no risk that the postage meter would be accounted for as a capital lease. Under the new guidance, an operating lease must be measured as a liability on the balance sheet, and thus accumulated effect of the free postage meters, if meeting the definition of lease, might be material to the financial statements and require identification, recognition, and measurement of a new liability. Under the new lease accounting rules, the way to distinguish between finance and operating leases remains pretty much unchanged, except that FASB eliminated the bright lines in the rules. That is, the 75% of lease term and 90% of fair market value rules are no longer hard and fast, which is what some of us that have been in the profession for a long time are used to. But primarily because the board is primarily moving away from this because they're moving away from a rules-based accounting to a principle-based accounting. So basically they're wanting more thought and more professional judgment in application of the rules. With the new standard, there are now 5 lease classification criteria for which to base whether the lease should be classified as operating or finance. These criteria are similar to the 4 criteria under the old guidance, but require greater judgment because they do not include explicit terminology, bright lines, so to speak. A lease meeting any of these following 5 criteria is classified as a finance lease. And here are the 5 criteria. Ownership is transferred at the end of the lease term. Basically, it means you get to keep the equipment. A bargain purchase option, one that is reasonably certain to be exercised for the leased asset exists. And I like to think of that as when you see those contracts and they have a dollar buyout. And the lease term, which does not commence near the end of the economic life of the leased asset, is primarily for the remaining economic life of the leased asset. The present value of the lease payments and residual value guarantees is equal to or more than substantially all of the fair value of the leased asset. And the leased asset has no alternative use to the lessor at the end of the term because of its specialized nature. So those are the new 5 criteria. And so they do have some resemblance to the old criteria, such as, like, I always remember thinking about, well, if you got a $1 buyout, you know, you're almost at 75% of the lease term, the asset life. So it's very similar, but it is a little different. After classifying each lease, the lessee must then measure them. The measurement of an operating lease is the most significant difference from previous GAAP. The lessee will be required to place all operating leases with a duration of 12 months or more on the balance sheet. So if the duration's less than 12 months, then it won't need to be treated and put on the balance sheet. But if the duration is 12 months or more, it needs to be put on the balance sheet. Operating leases, which are presented separately from the financing leases, must have the right of use asset and related lease obligation measured. At the effective commencement date, the lessee will measure both assets and liabilities at the present value of the prospective lease payments using either the lessor's implicit interest rate or, if not, readily determined at the lessee's incremental borrowing rate. And that basically means the rate at which the lessee could borrow for a similar amount from their lending institution. So what I like to do there is look at what debt they have on the books, what rates those are. That would give you a good idea of what they could borrow money for at a particular time. Current GAAP requires companies to use the lesser of the rate implicit in the lease, if known, or the company's incremental borrowing rate. The new lease accounting rules would always require companies to use the rate implicit in the lease if known, even if that rate is greater than the company's incremental borrowing rate. So that's a change there. It should be noted, however, that the rate implicit in the lease is usually very difficult to determine. As such, companies will most likely continue to use their incremental borrowing rate to determine lease liability, even under the new lease accounting rules. The sum of the lease payments of the operating lease will be amortized on a straight line basis, with each payment charged to lease expense and corresponding credits, one, to the lease liability for accreted interest, and two, to the asset for the difference. The effect of this treatment would be to amortize the asset using the effective interest method, which applies a constant interest rate to an unamortized debt. While not explicitly stated, the effect of multiplying the interest rate used in the present value calculation by the amount of the lease liability and subtracting it from the total lease expense is to apply a constant rate to the asset. At the end of the lease term, the right of use asset would then completely be written off. So that's kind of a quick overview of the standards. So with that, I'll turn it back to Randy.
All right, thanks a lot, Erica. Hopefully, mine aren't as voluminous here. I gave her the big ones. That's how I told you I was going to pawn off stuff on her that I didn't want to do. So the next one here is ASU 2016-14, which relates to the presentation of financial statements for not-for-profit entities. And while it just deals with that one industry, it was a pretty distinct and clear change that had, in my mind, about 3.5 main provisions to it that are different from how things were going to be in the past. So prior to adoption of this, the net assets on a not-for-profit organization were split into 3 different categories. You had unrestricted, temporarily restricted, and permanently restricted. And those were broken down now where there's only 2 classes of net assets moving forward. Those are net assets with donor restrictions and net assets without donor restrictions. So the with donor restrictions replaces both temporarily and permanently restricted net assets under the previous reporting model. So then that creates additional disclosure in order to make sure that users and readers of the financial statements still understand what exactly the organization will have for available funds, what's the nature of those restrictions, and how long are those restrictions going to last. So as with almost any major change that you see, there's additional disclosure requirements to help provide additional clarity. The second main item that this standard employs is that there's now a required statement of functional expenses for all not-for-profit organizations. And I've seen in practice, I do a lot of peer reviews, so I go into other firms and I look at the work they do, and I see a lot of variation in practice on this. So functional expenses sometimes were not included at all. Sometimes they were essentially considered to be in the footnotes. This standard basically says you have to have a statement of functional expenses and that you have to present your expenses in both a functional classification, meaning broken down between program expenditures, management in general, and fundraising, as well as a natural classification as well. So that'd be wages, rent, utilities, etc. So you need to present both of those. So that statement of functional expenses will do that. And you typically see that in the natural expense classification listed down in the rows, and then you have columns for whether it's program, management in general, or fundraising. Now, this did not change at all the allocation methods that are to be used. So, if an organization has previously been issuing statements of functional expenses, it doesn't change how they need to do those allocations. It just now requires that all not-for-profit organizations are required to include that statement of functional expenses with their financial reporting package. And then the third significant change, and I think this again relates kind of to that first one of temporarily and permanently restricted being now just with and without donor restrictions, is a required footnote on liquidity and availability of assets that will allow the organization to meet their needs on expenditures. So there will be a footnote in all financial statements that will indicate what kind of liquid assets they have. And that will include cash and investments. It will include things like inventory and receivables, and anything else that is essentially liquid that they might have on their balance sheet. Now, within that footnote, you would need to then break out which of those assets that appear to be liquid, cash, investments, et cetera, may have restrictions or other things on them that will not necessarily make them available to the organization to meet short-term financial needs. So that's where if you have endowment assets that you cannot spend the principal amount of those investments that were donated to the endowment, those would then be restricted assets that would not be available to meet current expenditures. If there are other restrictions that will basically go away over time, but not necessarily within the next 12-month or next reporting period, then those would also be considered to be either restricted or unavailable. And if there are restricted assets, and you see that certain organizations might have a bond issuance or some other debt arrangement where they're required to keep certain levels of cash or investments that are secured for that debt arrangement on hand. So those may be restricted and again, not be available. So the footnote would need to outline of all of the liquid assets that the organization has, how many of those are really liquid and available in order to meet their current expenditures. And that's basically what's required to go in there. And I see a lot of liberty with what's put in there, and again, these are principles-based standards, so there's a lot of flexibility. So for example, if an organization has very little in liquid assets, but they have a recurring government grant that gets paid monthly, they've had it for a number of years, it's been renewed, those funds will become available. I've seen organizations want to include that in the footnote, that we have this grant that's going to generate X amount of cash and liquid assets in order to help facilitate the fact that, we only have about 8 days worth of cash on hand at year end, but that doesn't mean we should panic, because we do have that grant available that's going to provide that liquidity that we need. So again, those are kind of the three big things. The half a thing that I say is also a moderately significant change related to this standard is that for any not-for-profit organization that presents their statement of cash flows using the direct method, which probably knocks it down to about less than 5%, they are no longer required to present the reconciliation of net cash from operating activities. Now, what I've seen primarily in practice is most organizations or most firms who assist organizations with the preparation of their statements use the indirect method. So this only applies to the direct method. The indirect method is essentially the reconciliation that's no longer required if you use the direct method to get yourself to your net cash from operating activities. Both methods then require the cash flows related to investing and financing activities to be displayed as well. All right, so moving on from that. Few more things that I've pawned off on Erica here. FASB 2008, ASU 2018-8. Take it away, Erica, for the two items on this slide.
Okay, I'm going to be much quicker on this one.
I hope so.
Basically, in an effort to decrease the diversity in practice and how entities record grants, the FASB issued ASU 2018-08. And it was to clarify the factors and criteria to be considered when determining whether a transaction should be characterized as an exchange transaction or as a contribution, and B, a contribution is or is not conditional. And so the new pronouncement is expected to have an impact on the way not-for-profits recognize grant revenues and report them in their financial statements. However, I mean, this is mostly pertains to not-for-profits, but it could be applicable. Oh goodness, can't say that word. It could apply.
Applicable.
Yeah, thank you. To those for-profit entities, otherwise commonly referred to as business entities that have grants and donations as part of their operations. ASU 2018-08, it now ensures that organizations' managements will need to review each grant individually to determine the underlying conditions and responsibilities and to assess the impact of the timing for the recognition of the related revenue. This ASU may result in more grants being classified as contributions. And then, so ASU 2018-11 targeted improvements. This kind of relates a little bit to the lease stuff that we were talking about earlier. ASU 2016-02 initially provided, which was the lease standard we were talking about earlier, initially provided a single transition method with which to adopt the new leases guidance. The modified retrospective transition method was what was initially provided. And under the transition method, entities apply topic 842 retrospectively to each prior reporting period presented, including the new and enhanced topic 842 disclosure requirements. The FASB took into account some stakeholder feedback and decided to provide a new transition method. Under the new transition method in ASU 2018-11, entities can initially apply the new lease guidance at the adoption date and recognize a cumulative effect adjustment to the opening balance of retained earnings in the period of adoption. If an entity elects the new transition method, it is required to provide the topic 840 disclosures for all prior periods that remain under the legacy lease guidance. And so with that, I'll turn it over to Randy. I'm much faster this time.
Absolutely. And typically with that adoption of the new lease standard, there shouldn't be much of an impact on equity because it's basically requiring an asset and liability of equal values to be entered. But I had heard somewhere somebody told me that, you know, one of the, it was like Walgreens or somebody, when the lease standard came out, realized they had like over 100,000 leases that they had to analyze in order to properly implement this. So I imagine that would take them a lot of time and people power. But that's not us. So moving on, ASU 2018-13, again, more tweaks to the fair value disclosure requirement. So for and I won't go into all of the details here, but for non-public entities, there was a requirement to have a reconciliation if you had any investments that were classified on level 3 of the fair value hierarchy. You know, level 1 basically is identical asset in an active market. Level 2 is an asset where you have a similar asset in an active market or an identical asset in an inactive market, or observable market-based criteria on which you base your assessment of value. And level 3 is where you basically don't have observable market-based inputs to determine what the fair value is. You're using things like estimated future cash flows or things of that nature. So there's a required reconciliation. Well, that reconciliation essentially goes away, kind of. So the reason I say that is the reconciliation basically started with your beginning balance. It added any purchases, subtracted any sales, and then included any appreciation or depreciation and any transfers into or out of level 3. Now, since I mentioned that transfer word, and then it comes to the ending balance there, and that's your reconciliation. But since I mentioned the transfer word, essentially transfers don't happen. That is when the investment that you have, which was a level 3, becomes an investment that's no longer a level 3 or vice versa. So that means that you would have had to have either now the appearance of market-based criteria on which to determine the value, or the disappearance of market-based criteria to determine that value. So other than some very remote circumstances, like a private company going public, for example, or a public company delisting, it's unlikely that you're going to have any transfers. So I basically say, kind of blanket rule, there are no transfers. So your reconciliation was beginning balance, purchases, sales, appreciation, and ending balance, because, you know, there are no transfers. Well, so what it took away was it said, okay, you don't need to do that reconciliation, but you still need to disclose transfers, sales, and purchases of your level 3 investments that were made during the year. So basically all that removed is your beginning and ending balance and your appreciation. So the beginning and ending balance are already on the face of the statements. The appreciation was the plug to get it to balance. So I don't think it really significantly changed the disclosures a whole lot, but it really sounded like they were trying to give us some simplification there. All right, Erica, on to the next one.
ASU 2018-17 targeted improvements to related party guidance for variable interest entities and VIEs, as we call them for short. This standard expands guidance for not needing to consolidate VIEs for non-public entities as originally outlined in ASU 2014-07. Under the new guidance, a reporting entity may make an accounting policy election to not evaluate a legal entity under the VIU subsections if all of the following specific criteria are met. The reporting entity and the legal entity are under common control. The reporting entity and legal entity are not under common control of a public business entity. The legal entity under common control is not a public business entity, and the reporting entity does not directly or indirectly have a controlling financial interest in the legal entity when considering the general topics of subsections of topic 810. The amendments introduced by the amendments in ASU 2018-17 aligned two assessments, which had to do with the which had to do with the primary beneficiary test and the existing guidance for assessing whether a decision maker represented a variable interest entity. The amendment to this ASU, the amendment made by this ASU aligns these two assessments. Now the reporting entity should consider indirect interest in an entity held through related party under common control with the decision maker on a proportionate basis rather than in their entirety for both the VI and the primary beneficiary tests. So that's kind of a quick overview on that one, Randy.
Yeah, and much easier to deal with. And I think this was FASB feedback that they got from the users saying that you gave us all those VIE rules and we don't like them. So give us a rule that says for those privately held companies where there's common ownership, but it's not a controlled, I don't have a parent that owns subsidiaries. Don't make them consolidate because we don't want that anyway. So I think the banking community can be thanked for that. So. All right, so if you're panicking on our time as we're getting to the slides, we're going to blow through these. Our approach with the 2019 and 2020 standards is, since I'm often told that I'm odd, I'm going to take the odd numbered ones, and Erica's going to take the even numbered ones. So 2019-1, basically this is, again, narrow focus on leases. That there was an exception in the old lease or the current lease rules under topic 840 that you could use cost at the inception of the lease instead of fair value in certain situations. They did not write that into the 842 initial drafting, and now they have put that same exception into 842 as well to minimize the impact on the switchover. Next.
And the ASU 2019-02 improvements to accounting for films and license agreements for program materials. This will have a minimal effect on HHM's clients, but it changes in the capitalization rules for costs related to production of episodic TV series.
It sure does. And then 2019-3, again, so the only source of authoritative gap is the codification. So the only way the FASB can make any changes is to amend the codification, which they can only do through the issuance of an accounting standards update, which is why we have all these little narrow focus things. And what this one does is it updated the definition of collections as a not-for-profit would define them for museums to be the same as what the American Alliance of Museums uses in their definition.
In 2019-04, this is also going to have a effect, and it mostly affects lenders, that industry, but it is various minor changes to sections 326, which is financial instruments, 815, derivatives and hedgings. That's one of those bad topics I don't like, and 825, financial instruments.
Yes, I often say that if an entity has derivatives and investments, we should withdraw from the engagement.
Absolutely.
Sometimes I'm joking. 2019-5, again, narrow focus related to financial instruments that allows for the adoption of the fair value option for certain investments that were previously measured at amortized cost to allow for consistency in reporting similar investments an entity may have on its balance sheet.
In 2019-06, extending the private company accounting alternative goodwill and certain identifiable intangible assets to not-for-profit entity applies the goodwill amortization guidance in ASU 2014-02 and ASU 2014-18 to nonprofit organizations.
All right, 2019-07. I just wrote in my notes this one didn't even have the summary of why we issued it, or what. It was just 175 pages of technical changes to the codification for revisions and SEC guidance that they provide within the various codification sections.
And then 2019-08 dovetails off ASU 2018-07 and clarifies that stock consideration provided to a customer needs to be accounted for in accordance with the provisions of ASC 606, revenue recognition.
In 2019-09, adjusts an effective date of 2018-12, which relates to long duration insurance contracts, so it only impacts the insurance industry. And it also adopts a philosophy that's going to step on Erica's toes on the next one here, that for the first time, they said, we really want to give non-public entities a little bit more time to deal with these than what public entities do, because of the fact that public entities tend to have significantly more resources available to research and the impact and adopt the new standards.
So that, I guess, leads us into 2019-11, Randy.
I got to get my slides right here.
Oh, okay.
Okay. No, you're supposed to cover 2019-10, Erica.
Well, that's all I have. The philosophy to give non-public entities at least 2 years after public entities to implement new standards.
That's right. I specifically didn't say the at least 2 years so that you.
Okay, gotcha.
So yeah, tried to do that for you. 2019-11, again, some more minor updates and clarity in an area here based on financial instruments and credit losses based on feedback from users on ASU 2016-12, which essentially relates to credit losses. So if you have long-term receivables, so financial institutions, maybe pawn shops, buy here, pay here, car dealers, essentially to value what the recorded value is. There was an incurred loss methodology that was being utilized. 2016-13 replaced it with an expected loss methodology, which thus means that the asset amount should be equal to the amount you expect to be collected, which I guess I would have thought that's what you'd have had all along, but apparently not.
And 2019-12, that really has no impact on HHM currently, but it applies to intra-period tax allocation for interim financial statements issues, as well as tax treatment of foreign subsidiaries.
Exactly. So eloquently stated here. We're up to 2020 here, so we are in the home stretch. There's, I don't know, 11 of those that have been issued this year. So again, I get the odd numbered ones. ASU 2020-01. Essentially basically says that, hey, there's 3 different sections that deal with similar types of things, topics 321, 323, and 815, all in that financial instruments model. And basically it says that there was a allowable alternative to measure certain things that cost less impairment instead of fair value. And depending on which codification section it applied on, it didn't necessarily apply to all 3. They said, no, we really mean that to apply to all 3.
In 2020-02, really applies more to public companies, so it may not have much impact on us, but as certain SEC guidance in the codification related to financial instruments and leases is updated with this ASU.
Yep. And then 03 is one of my favorite kinds, where they say that this basically has no impact on professional standards. We're just fixing some of the errors that we have and inconsistencies between certain topics within the codification.
In 2020-04 will have minimal impact for us, but it relates to transition relief for companies with transactions are impacted by the change in reference rate, such as LIBOR within a contract.
Yep. And 2020-05, as I mentioned earlier, changes the effective date for revenue recognition. Again, the key there is that it was June 3rd of 2020 that was issued. So if our financial statement's not issued by that date, you got an extra year deferral to calendar year 2020 for non-public entities to adopt the new revenue recognition rules.
And ASU 2006, accounting for convertible instruments and contracts in an entity's own equity. That's a mouthful. Reduce the number of models for accounting for convertible debt and convertible preferred stock. No longer requires the conversion feature to be treated separately and accounting for as a derivative instrument.
All right, 2020-07 actually may have some applicability to us here. It requires not-for-profits now to separately present contributions of non-financial assets. For the most part, I think what we'll see there is if a piece of equipment is donated, someone donates some computers, desks, etc. Apart from contributions of cash or other financial instruments such as stocks or investments. In the statement of income that they provide, or statement of activities, I guess would be the terminology for not-for-profit. So they need to disclose the amounts of contributions of non-financial assets by category, if there's multiple categories, indicate if they were monetized, whether it's sold and converted into cash, or if they're used during the period and for which program they were utilized. They then also need to disclose the policy of monetizing non-financial assets that are donated. So I see a lot of not-for-profits would say, well, if we are given a donation of stock, we provide that to our broker and they are to sell that immediately and turn it into cash. Well, what is your policy if you're given a piece of equipment? I'm assuming that would be more towards if it's not for use within the organization. How do you then turn that into cash value so that you get the appropriate value of the donation applied?
And 2020-08 is just clarifies that an entity should reevaluate whether a callable debt security is within the scope of the paragraph 310-20-35-33 for each reporting period. And it just tweaks guidance at ASU 2017-08.
Yeah, and you guys can read all that stuff too if you want. 2020-09 is again just more SEC guidance that got updated and then put into the codification through that standard.
And then 2020-10 ensures that all disclosures related items in the codification appear in subsection 50, some are only in 45, and makes minor other clarifications.
And then the last ASU to talk about, which was just issued last month, this one defers the effective date for the provisions of ASU 2018-12 for long-term insurance contracts by 1 year due to the COVID-19 pandemic. And my thought on that one was it wasn't to be implemented until calendar year 2024. So apparently they're thinking this is going to have a significant impact and we don't have to now implement that until 2025. So with that, that concludes the prepared material that we had, and there's the lovely pictures that they gave for us. And then I was going to address any questions that we might have that come in, but I don't believe any questions have come in. But I can at least summarize for you and tell you that what my answers were likely to be to those questions are, we'll research that and get back to you, or that's beyond the scope of this presentation. So with that, I think that's all we have. Michaela can correct me if I'm wrong, but that concludes this presentation. We hope you have been able to get some value out of this, and thank you for attending.
Thanks, everyone.